I am a CPA and a certified tax planner. I've been a CPA for about 40 years, and we specialize in working with dentists and other professional practices to help them understand the tax code and what they can do to minimize taxes. And really, what we're going to talk today about is some of the basics and some of the basics of saving money on taxes. And our agenda basically is to describe what is tax planning, because a lot of times people don't understand what it is, why it matters, common tax challenges, how tax planning can help professionals, tax challenges specific to dentists, and specialized tax strategies for dentists. And then we talk about what action plan you need to put in place to actually make tax planning work. And we'll go through the conclusion after that. First of all, what is tax planning? A lot of times, your CPA or tax professional may just say, "Oh, my tax planning is just, I'll tell you how much to pay in your quarterly payments." Well, that's just planning payments. And you'll see how this changes in terms of when you look at what we are calling tax planning, what you're doing, it is a very, very different approach. And it's very, very different from tax preparation, which everybody does. Tax preparation is a compliance service. It's basically putting the numbers in the boxes in the form year after year, and it is basically a reactive type situation. Sometimes, get to the end of the year, you put the numbers in your boxes, and it's like, holy cow, I owe all these taxes. What do I need to do? And by that time, a lot of times it's too late. And the goals are to reduce taxable income, optimize tax deductions and credits, make sure you take every deduction and credit you possibly can, and really look at what we can do to plan for long-term wealth preservation. Why tax planning matters. Well, everything requires projections, calculations, and structuring, but it's totally worth it. These are the key strategies, okay? Accuracy, what you can and cannot write off in accordance with the law, and how to record and document all of those write-offs that you can possibly take. So many people, when I start to work with new clients, they don't understand every deduction they can take. And we're going to talk about some of those a little bit later. A lot of times people don't have the correct entity selected. Should they be an S Corp, a C Corp, sole proprietorship, LLC? Also, a key strategy is income splitting. Sometimes we can pay our spouses or our kids, or have other entities that we may be able to use to reduce our tax rates. Income shifting between entities, people, or years are also another good strategy that can be perfectly legal and is very, very effective. And also the matching of passive and non-passive income and losses and capital gains and losses. And also really using every single loophole allowed by law. Some are small, but they add up. If you have 3 or 4 different loopholes that are $5,000 to $6,000 in deductions each, suddenly you're saving really, you could have a $60,000 deduction that could save you easily 40% of that, or $24,000 in tax. And $24,000 a year, year after year after year, is a big deal. Reducing the great news about this is reducing taxes retains cash for expansion and long-term wealth building. If you pay half of your cash profits in taxes, it's twice as hard to build the wealth you need to provide for your business and your family. Tax planning typically reduces a business owner's tax burden by 40%. Okay. It's just putting everything in place and analyzing everything correctly and doing the calculations. It is our average savings that we're able to achieve. People who do tax planning typically are able to build a bigger business and have the wherewithal to thrive in downtimes and have a more comfortable retirements, because again, you're retaining more cash and paying less in taxes. Obviously, pay what taxes you owe on time. Staying compliant with tax laws and deadlines prevents costly penalties. Tax planning is like anything else. Planning is the key to success, right? We plan treatments for patients. We plan marketing and advertising. We plan personnel development. We plan practice management and practice growth. We do estate planning. We even plan our vacations. And really, failing to plan is planning to fail. And that's kind of an old saying that's out there, but it's absolutely true. Unfortunately, a lot of people don't believe that proactive tax planning and managing income taxes is not a thing. A lot of times people are just stuck on the compliance wheel, where let me just fill out my tax returns, get them in on time, because it's kind of the last minute thing that you do, right? Common tax challenges for dentists, navigating the complex tax laws. And this is really one of the reasons why people don't do tax planning and are stuck on compliance. Tax laws frequently change due to legislation, making it difficult to stay informed. Complex terminology and varying regulations across states and countries add to the confusion. Overlooking available deductions, inaccurate data, and really not taking all the credits you should. Many taxpayers fail to claim eligible deductions. Home office expenses is a great one. Energy efficient credits. There's also the work opportunity tax credit, simply because they're unaware of that. All right. And then the lack of proactive planning. Taxpayers often take that reactive approach that we talked about, addressing taxes only at filing time rather than year round. But with proactive planning, opportunities to reduce taxable income, without proactive planning, opportunities to reduce taxable income are missed frequently. How can tax planning help professionals? Professionals such as dentists, doctors, attorneys, athletes, etc., face unique financial tax challenges due to high incomes, sometimes fluctuating earnings, and specific career-related expenses. Tax planning provides tailored strategies to help each professional retain more of their earnings and optimize their financial plans and ensure long-term financial stability. One of the keys here is that a tax plan is unique to the individual professional. Okay. Because when you do the tax plan, you have a business that creates the income, but the individual that's getting the money from that business creating the income may have different structures. For example, one of the things we're going to talk about is paying your kids out of the business. Any child above age 7 can be paid to work in your business, and they can earn up to $15,000 a year in 2025 on a tax-free basis because their standard deduction is $15,000. But you also may have kids in college. You may want to take a different approach with that. Some of the basic tax strategies for dentists that we can cover. One of the most important ones is depreciation. Depreciation is kind of a little bit of a magic number because it allows you to shelter your income from taxes. But if you go to the bank for a loan, they're going to add back depreciation. And all of your assets like dental equipment, office furniture, computers, you get to write off over their useful life. We can, there's an interesting situation that's coming up with the extent. Donald Trump has proposed a new tax law that's going to extend the 2017 tax law, and it'll allow you to write off 100% of any assets that you bought in the year you buy them. So it's called 100% bonus depreciation. A lot of times, and we're talking about that right here, bonus depreciation, and sometimes Section 179 that allows you to take 100% of eligible purchases. It's important. So if you're thinking, I need to remodel that office, right? And if this 2025 tax law comes through, you could remodel that office, and a lot of your improvements are qualified improvement property, which qualify for bonus depreciation. So let's say it's time you want to spend $25,000 to remodel your waiting room, or add another chair or whatever you want to do. That would be 100% write-off in 2025. A lot of times there's the question of lease versus buy, and this is an area where I see a lot of professional practices and dentists. They get a contract from a company that it's called a lease, okay? But it's really, that lease is really has a bargain purchase option at the end, meaning you're going to own the equipment when you're done paying the lease. Well, that's not really a lease, that's a loan. And that equipment, you don't write off the rental payments, you write off all the equipment when you buy it. So it can be a situation where you can get a lease or a loan to buy the equipment. All of the interest related to that loan, you can write off your business, but you can also write off the equipment, okay? Installation costs can be written off along with the piece of the equipment. So if you're installing a new x-ray machine or any other piece of equipment you have to, those installation costs are written off along with the machine and can be considered depreciable costs. Qualified improvements, 15-year property versus 39-year property. The 2017 tax law reclassified qualified improvements to 15-year property, which means they can be used for bonus depreciation. And one of the things I pointed out earlier was depreciation facilitates leverage, okay? Meaning it's great because you write it off your taxes. On the other side, that bank adds it back. So if you want to go borrow more money, and let's say you want to build a second office and you want to go to the bank and borrow some money to build a second office, you could add back all of that depreciation so that the bank really understands your cash flow. That's a common way that the banks work things. Cost segregation. For dentists that own their practice buildings, a cost segregation study accelerates depreciation on certain building components like flooring, HVAC systems, lighting. This strategy can result in upfront tax saving by separating assets into shorter depreciation categories. So let's say you buy a building. You want to buy your own building, and it's a commercial building, so those are generally depreciated over 39 years. If you want to go through that building and do the cost segregation analysis, you can break that building down into the individual components. For example, the sidewalks may be 15-year property, right? The flooring may be 15-year property. And any property under 20 years qualifies for bonus depreciation. Your HVAC systems, your plumbing, your electrical can all qualify. And typically when you do cost segregation on a building, you are able to pull out about 30% of the cost. And with the new Trump tax law coming through, those can all be subject to 100% bonus depreciation right now. Okay, so that would be very, very exciting. I mean, if the tax law doesn't pass, it's 60% bonus depreciation. You can also use Section 179 to write those off. So cost segregation is what you need to remember, and it's really a great way to do things and to minimize your taxes. Owning your own building is a great wealth builder because it gives you that depreciation, right? And you're depreciating an appreciating asset. So one of the things I really like about real estate generally is appreciating at 4% a year. So it's appreciating, but you're writing it off your taxes and depreciating it. So that's always a great way to do that. The thing you have to do is you have to watch your corporate structuring on your business because we want to avoid passive loss rules. Passive loss rules basically says you can't take passive losses from real estate against your earned income or non-passive income. The Augusta rule. This is one of my favorites. It's not a big loophole, but it's a pretty interesting one. You can rent your home to your dental practice for meetings or events for up to 14 days per year without paying taxes on the rental income. Okay, so let's say you charge your practice $1,000 per meeting for 14 meetings, reduces your taxable income by $14,000, which could save you, if you're at 50% tax bracket, up to $7,000 in taxes by creating that tax-free income. Documentation is required, meeting minutes, agreements, and so forth, that any competent tax professional can take care of for you. It is location specific. Okay, so you could also, let's say you have a personal residence you're renting for meetings. You also have a retreat property that you could rent to the practice for meetings. Okay, it is location specific. Okay, this was actually born out of the U.S. Open. That's the Augusta National Golf Course, and many people around the golf course during the U.S. Open rented their houses out, and the IRS were going back and forth with these people as whether it's taxable, and they just created this rule because they realized it was too much of a pain in the butt to try to figure out whether or not people were making money on this or not. So they said, okay, fine, you guys can all do this. And then a lot of people started using it. Home office deduction. Reimbursing yourself for your home office cost is a working fringe. Okay. Many companies, especially during COVID, reimburse their employees for their home office costs because they couldn't be in the office. And it is very much a standard practice within the tax code that if you have a home office, your company can reimburse you for the cost of that home office. I know, and all the dentists that I work with spend significant time at home, going through files, looking at digital pictures of cases and so forth. And almost everyone has had a home office, right? And those home office costs can be reimbursed by the business. And again, as a working fringe, it's a fringe benefit. It's not taxable. You deduct it from your business, let's say $600 or $700 a month, pay it to yourself. You could do it on your W-2 as a reimbursement and deduct that. Again, that's going to be another $7,000 or $8,000 of income that you're moving from taxable income to tax-free income. Other home income expenses can be directly deductible to the business. Let's say your home internet. You need the internet to review your files. Maybe you need a network or whatever to keep your files safe. And to do that, you can definitely declare that. And then declaring your home office as an administrative office to your business makes your daily commute deductible. So if your company is administrative office is your home, your daily commute can actually be deducted. So these are standard loopholes that we apply to most of our clients. Hiring your spouse. Paying your spouse a reasonable salary for assisting with office tasks, scheduling, marketing, whatever, provides a tax deduction while enabling your spouse to make contributions to retirement accounts. Let's say you have a 401k for your practice, right? And if your spouse is not being paid by the practice, she can't put any money aside. But if you give her a wage equivalent to what she can save in a 401k, you're basically taking taxable income and making it tax-free income and helping building up her retirement account, okay, or his retirement account. So an example, $23,500 of employee deferrals and $70,000 of employee deferrals are allowed under a 401k plan. You also have Roth IRAs, executive bonus deferred compensation arrangements that can be deductible to the business and actually paid to your spouse. Hiring your kids. You can employ your children in your practice, cleaning, filing, marketing, social media management, whatever. Any child, the tax law is, and it's been proven out in court cases since the 1900s. Above age 7, they can all be paid to work in your business. And like I mentioned before, there are documentation requirements, right? And imagine paying $15,000 a year. That's the amount that they can take in 2025. And it grows a little bit each year. If we do this between age 7 and age 18, we have $165,000 set aside for that child. College, whatever, you can also use that money to pay for their activities or schooling or whatever else you want to do, right? Wages paid to children 18 and under are not subject to Social Security or Medicare taxes and are deductible as a business expense, okay? So like I just said, basically paying your child $15,000 a year can reduce taxable income while funding their education and savings. Writing off cars. A lot of times we can deduct the cost of the vehicles as a business for business purposes under bonus depreciation or Section 179, or we can do mileage reimbursement, whichever works best, right? Depends on how much you drive, right? And that's when we consider this along with the home administrative office. Again, that makes your daily commute a business expense because your admin office is at your home, okay? A large SUV or truck weighing over 6,000 pounds gross vehicle weight rating may qualify for bonus depreciation, okay? It's an important thing that I have people come to me sometimes and say, my car doesn't weigh 6,000 pounds. It's not the weight of the car, it's the gross vehicle weight rating, which is a combination of the weight of the vehicle and also the towing capacity of the car, of the vehicle, okay? Health savings account, great way to do this as well. Again, it's a smaller type loophole or deduction you can take, but in 2025, it's $8,550. Again, you can contribute tax-free, the funds grow tax-free, and use funds tax-free for qualifying medical expenses. It's kind of a triple tax advantage, makes this ideal savings tool for high-income earners. And we also have multiple family employees that can take advantage of this as well. And it's a way to set aside money long-term that you could use when you retire. Advanced strategies for dentists. Now, some specific strategies that can really apply to dentists. I mean, all of the things I just talked about would definitely work. But let's say you're doing really well, you're making a ton of money, and you need to think about you've taken advantage of all those loopholes and taken advantage of all those strategies. Well, what else can we do? Short-term rental loophole. One of the things, and this especially works for people that have also high W-2s, if most rental properties where you're renting a property for a month on a monthly basis, or they have a year lease, any income or losses from that property. So let's say you go and you buy a house for $750,000 and you do a cost segregation and you have $250,000 of depreciation you want to take against your other income. If it's not structured properly, it won't work because it's considered passive loss, and you can't take that passive loss against your non-passive or your earned income, right? However, the short-term rentals, the Airbnbs, like the Verbos, whatever, are not classified as rental property. They're classified as a separate business, and they can offset active income with depreciation and other expenses, right? So this strategy works for a dentist as a high income earner, bypassing passive loss activity limitations, and if managed actively for 100 plus hours a year. So it's not a hard um, standard to meet, and it's a great way to create a kind of a side hustle, to take the write-offs for depreciation. There are many, many clients that work this and do this and take large write-offs for the depreciation of an Airbnb property. I mean, and you can take those write-offs in the first year, you spread some of the depreciation over the other years, and generally can create some very, very good tax-free cash flow. Retirement plans, maximizing contributions to retirement tax advantage retirement accounts. Defined benefit plans you can definitely use. You can shelter significant income while building retirement savings. Obviously, the 401k profit sharing plans. There's many, 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 many different types of plans, and those need to be individually designed to your business, but you should definitely be exploring those, okay? So, and you can combine employee and employer contributions to save up to $70,000 a year, okay? And these are tax savings today that will help you go for long-term financial gains or long-term financial growth. Other real estate strategies, investing in real estate to benefit from depreciation, mortgage interest deductions, and cash flow. And then usually real estate strategies are very, very good. So if you have a number of properties that you're depreciating and taking write-offs for, you want to make sure to also use the 1031 exchange to defer capital gains when reinvesting in similar properties. One of the other things on the real estate strategies that I didn't write down and list on here, but it's very prevalent, is if you are a dentist and your spouse qualifies as a real estate professional, then we bypass those passive loss restrictions. His or her income, the spouse's income and losses from the real estate investing are also considered active, not or non-passive income that you both can write off against each other. So I have many doctors and dentists and other professionals that they decide to have their spouse manage a rental property portfolio, and then the spouse is qualified as a real estate professional, and we're able to deduct the depreciation. I'll give you an example. I actually have an airline pilot airline pilots make very nice W-2s. And we qualified this airline pilot as a real estate professional. And it's like, well, how did you do that? Well, the airline pilot took meticulous notes of what hours he spent on what activity. And it's actually federal law that pilots can only fly 20 hours a week, right? All the other time that this pilot was on layover and so forth, he was working his real estate business. So we were able to prove to the IRS that he spent 50% of his time as a real estate professional, or 51% of his time as a real estate professional over the year. And so he has been qualified as a real estate professional, invests a lot in real estate, and gets all of his withholdings back every year. So it's kind of a unique situation because IRS challenged that. And we went through the appeals process and we won. So that was pretty exciting. Entity optimization. Are we using the right entity? Very, very important, okay? Transitioning to an S Corp to reduce self-employment taxes by splitting income between salary and distribution. The S Corp is a good strategy. If you're just a sole proprietorship, everything, your first, I think the total is 162,000 is subject to self-employment tax. With an S Corp, you can split that and reduce the self-employment tax by taking some money as wages, reasonable compensation, and the rest you can take as profits. You're transitioning to a C Corp for lower tax rates and to avoid passive loss trap for real estate. If you have a lot of real estate, a C Corp can be a very great way to make things happen. C corporation tax rates are 21%. Your individual tax rate, by the time you're making some decent money, can go to 24, 32, 35, 37%. Okay. So just thinking about that differential, and a lot of people freak out on a C Corp. They say double taxation is going to be a problem. You can't be a C Corp. Well, it's not double taxation in C Corp can always be avoided and is completely unnecessary. There's 7 different ways to take money out of a C Corp without double taxation. And then using LLCs for the right projects. And how you structure those LLCs and who the members of the LLCs are can be really, really important in terms of passing savings back to your personal return and to your business return. Tax challenges specific to dentists. There are certain things that are just specific to dentists that are tax challenges. We have high income earners with significant expenses. Um, you make a good income, but on the other hand, you have your student loan burdens that you need to pay off, and we can write off some of it, but not very much. We have ownership of private practices and certain equipment and technology costs. I mean, you guys know all in all that you operate in really a specialized financial and professional environment that distinguishes them from other professions, right? And the rules, the HIPAA rules, and everything else that you're required to deal with, can create problems and additional costs for you. So some key tax strategies that we can use and specialize for high income earners with significant expenses, right? Maximize tax advantage retirement contributions, right? 401k, SEP IRAs, or defined benefit plans. Defined benefit plans are really great. I mean, there may be a time, and it all depends on the life cycle and where you are in your practice, right? There may be people that have a very new practice where they have a lot of depreciation from equipment that they had to buy, and there may be people that have a mature practice where they're making more money and they want to click in a defined benefit plan, because a defined benefit plan lets you pay based on how much of a benefit you want to achieve at the end. And some of those defined benefit plans allow for very, very large contributions. Charitable contributions, including cash gifts and non-cash contributions donated, such as donated dental services or an equipment, can also be write-offs that you can take. A lot of times we can do income smoothing to defer income to the next year if your practice expects a lower revenue year ahead. You can also do things like prepay some expenses. If you're a cash basis taxpayer, there's nothing wrong with prepaying expenses. Let's say you had a great year for whatever happened, and you're like, oh my goodness, we're getting to the end of the year. We're looking at a situation where we're going to face big tax bill. You might be able to prepay your rent, prepay your health costs for your employees. You may be able to prepay utilities and your lab bills or whatever else you need. You're going to spend money on in January. You may be able to move those to December. For example, I've had dentists that said, you know what, every month I'm spending $20,000 on my lab. I'm going to send them a check in December, and there I'm covered, right? And it's interesting because a lot of us know that the dental business kind of can jump up in November, December as people are like, holy cow, I better get to the dentist because I got to use up my planned money from their own medical plan or their dental plan that their employer offers. Tax advantages, also advanced tax strategies, municipal bonds, is another possibility to use to get some tax-free income. You can student loan burdens, claim up to $2,500 annual for qualified student loan interest if the income minimum is allowed. You can do some refinancing of those student loan burdens. There are people out there and I have worked with dentists that have, refinanced things to spread them out. But some of those, if there is a loan forgiveness that could happen, we gotta watch out for that because it may be taxable. I'm not sure that's still going to move forward now with the change of administration, but that's where we are. Choosing the right business entity and the ownership of a private practice, managing personal and business finances, and balancing tax efficient structures and employee related expenses like payroll taxes. So really, the S Corp or the C Corp, obviously we talked about S Corp and splitting to reduce self-employment taxes. But if you're making a good chunk of money and you are pushing, $100, $200, $300,000 to your personal return from your practice, it's really important to consider a C corporation, okay? Because once you get in, you got to look at the total rate, right? The personal federal rate, I know a lot of us live in different states, but the personal federal rate can go to 24, 32, 35, 37%. Okay. Um, the C Corp rate is 21%, right? And Trump's talking about on the new tax plan lowering that C Corp rate to 15% for manufacturers, right? Or, we don't know exactly how that's going to be defined, right? Let's say you're a dentist that happens to run a lab too. Is the lab going to be a manufacturing entity? So that could have interesting implications, right? Because I do have some people that do run labs, right? So the C corporation strategy could be really, really interesting, in terms of reducing your rate and how you allocate income. Okay. So leverage depreciations for office space, you own your own office, cost segregation we talked about before to make sure we can reduce the tax burden as much as possible by using advanced depreciation techniques. Employee benefit deductions, deduct the cost of providing benefits like health insurance, retirement plans, continuing education is another. A lot of people don't know that continuing education can be a deduction to the business, even your education as a dentist. If you manage your practice administration from home, claim a portion deduction of your home office. We talked about that as well in terms of what we can do. And that actually, let's say your spouse is helping you with, whatever you're doing in your practice and working out of the home office, right? You can combine that home office reimbursement, like we talked about before, with, the 401k strategies and everything else like that. So it could be very, very interesting. Section 179 deduction, deducting the full cost of the equipment, the leasing of the equipment, deductible is a business expense if you do have a real lease that you have. Technology investments such as software, subscriptions, fees for practice management systems, patient scheduling, and billing revenues, they're all deductible technology investments. Energy efficient credits. Let's say I had a client that owned their own building and they put solar on their roof and they took the deduction for the solar credits. Then some of those solar credits can be up to 40% now for US made products. So it could be very, very interesting. So, once you have, I think one of the keys that you need to do is to have an action plan for really executing on your strategy. And really the action plan would be to assess your current tax position. We got to gather your latest tax return and supporting documentation, income statements, business expenses, balance sheets, identify your current marginal tax rate, tax deductions and credits used, which is basically trying to figure out what bracket are you in, 24, 32, 37? And then we pinpoint underutilized opportunities such as retirement contributions and the missed deductions, like some of the loopholes we talked about, Augusta rule, home office, your cars, and everything else that we can possibly do. We want to make sure we organize and track your financial records, use accounting software, QuickBooks Online, Xero, to track your income and expenses systematically. Really, accuracy is one of the biggest things that trip people up, and forgetting to take all the write-offs. You know what I mean? And really understanding what they should run through the business bank accounts and what they should run through the business credit cards, and making sure you segregate your business from personal. Segregation of business and personal expenses is really required by the IRS. Okay. That's one of the things they look for. And when you commingle things, and should you get audited, they get a little bit antsy, right? So they think that you're not organized. But when you are organized and you show a process and everything else like that, your auditors feel more comfortable. And they're like, okay, these guys know what they're doing. They're probably doing everything right. And they do the interview and they ask you all these questions about things, and it becomes a really, really interesting process. And it's actually an assurance type of process for the auditor, so they don't look as hard. Identifying tax saving opportunities, right? I forgot to mention this though. I think categorizing professional expenses such as travel, equipment, and marketing costs and education costs are really important. Making sure we don't write them out of personal, we write them out of the business account. Keeping detailed receipts and invoices to support tax claims. Okay. You should not ever think that your credit card statement is going to suffice for the IRS and an audit, because they need to see the receipts. Okay. And the great news is with modern software, you have tools like HubDoc, Receipt Bank, whatever, you can simply scan those all in, or have your bills emailed directly into those things, and it will organize it for you. So it's very, very easy to keep your receipts. We had a client that's actually not in the dental business, in the airplane business, and the IRS came in to audit, and he had kept all his receipts in this cloud-based tool. We were able to get him to the audit. We said, so the auditor was thinking, I'm gonna disqualify all his expenses because they don't have the receipts. Well, we had all the receipts and we sent it to him, and then they went away. So that's always a good way to do it. Identify tax saving opportunities, consult a tax advisor to explore advanced strategies. We talked about cost seg, office depreciation, retirement savings, defined benefit plans, and so forth. Check eligibility for credits and energy efficient equipment costs. So another thing I want to mention on credits is the work opportunity tax credit. If you're hiring people who are from a background where they need, or you're in a location that qualifies for work opportunity tax credit, you hire people that come off unemployment, or maybe their welfare, or they work to get their education and so forth. You can get tax credits for that. Okay, for the actual work that you're helping them get the job, you're training them, and you can get some tax credits. And then the fourth step is really, let's look at optimizing your business structure, like we talked about, your current entity, LLC, S Corp, C Corp, etc., with a CPA to ensure that you have the most tax efficient option available. Revisit your salary and dividend allocation if an S Corp. Your salary should be what's called reasonable compensation. And there are actually reasonable compensation studies you can do to qualify and make sure that you're safe when it comes to the IRS. For example, let's say your practice is earning $400,000 a year and you're paying each off a salary of $20,000 a year. Well, you're in a risky place, right? Because I mean, you're only paying FICA, your Social Security, on the 20 grand, but the IRS can come through and say, nah, that's not reasonable for a dentist. And what they'll do is they'll look at market rates and everything else, and you want to get somewhere close to the reasonable compensation, or ask your CPA to do a reasonable compensation survey to make sure you're in the right structure. I've been through audits on that with my clients, and they've been in the right place. Okay. Considering restructuring if your tax liability is easy for me to say, disproportionately high. Okay, so actually, Mark just asked a question. Thank you for asking that question, Mark. How long do you have to keep business receipts? You generally want to keep business receipts. The IRS can audit you for the prior 3 years. Okay, so they have a 3-year period that they can audit you. So, but there's also a requirement that if they can look at you, it's 3 years from date of file. Okay, so your 2024 receipts you file in 2025, you want to keep 2024 for a minimum of 3 years. And really what you should do is keep it 7, because if they find a way to detect fraud, they can go back 7 years. Okay, so, and it may or may not be real fraud. It can be something that they're concerned about, and they can activate and go back 7. So the best answer would be 7 years. Okay. To keep your tax returns and the required receipts and all the other documentation related to the tax return. Leverage timing strategies. We talked a little bit of accelerate expenses into the current year if income is higher than usual. Prepaying rent, ordering supplies. We talked about that. Defer income into the following year if you expect to be in a lower tax bracket, right? So some dentists, are very, very busy in December, and some dentists are not so busy in December. So they may take Christmas and New Year's weeks off, and as a result, deposits may not be made to the bank. They may just accumulate, right? A lot of dental plans are paying you so forth EFT. You can't stop that, but you may just not have the staff there to make the deposits, right? Plan equipment purchases to maximize deductions using Section 179 or bonus depreciation. Again, the planning. You had a great year. You're thinking about upgrading your office, like I talked about before, or maybe you need that new piece of equipment, or maybe you need a new network server, or whatever you need to do to make sure that you are in the right place, and you're thinking about doing it next year. If you had a great year, you might do it this year. You know what I mean? Or if you had a bad year, you may want to do it next year. It all depends on when you have the cash available and how you can do that. Because again, the 100% bonus depreciation is a dollar for dollar write-off, right? And if your tax rate is 40%, you're effectively, by writing that off now, could save 40% taxes in the current year. Because a lot of tax planning is about timing, right? And saving money sooner rather than later, because the time value of money really is important. Um, you want to make sure your quarterly payments are accurate, right? You want to look at, am I making more money than I did last year, significantly more that I need to actually, put more in on the quarterly basis and ensure payments are in line with IRS safe harbor rules to avoid penalties, right? Um, Plan for long-term tax efficiency. Maximize your contributions to defined benefit plans or 401ks. Consider Roth conversions during low-income years is another thing you can do. Once you do a Roth conversion, you have taxable income in that year, but then any remaining growth becomes tax-free. Consult a professional. Work with a CPA or tax advisor, especially in healthcare or small businesses, and schedule a periodic check to adjust strategies as laws and income levels change. I mean, with the new tax law, we're looking at big changes, right? That should generally change your um, business strategy and your income producing strategy. Okay, it's going to be very, very important, and will make massive changes. Like I said, you may want to get to a situation where you are doing some major expenses this year to take advantage of it. This is a good question that Mark asks. I sold my practice last year, but still have ongoing business activities and expense to support the new buyer. How should I be planning for these costs for the 2025 tax year planning? So those costs are definitely business deductions. Okay. So my question is, if you carried back the loan when you sold your practice, your capital gain from the sale of the practice is going to be spread over those years, so we can definitely offset that. Or are you supporting the new buyer and getting some sort of, like compensation as related to that? That would be my follow-up questions there. But they're definitely deductible. But you don't necessarily need to have, I mean, you recorded the income in 2024. You have the expenses in 2025. You have opportunities to still take those losses, even though you had the capital gain in 2024. So you can definitely take those losses. You could put them on a Schedule C, or I don't know if you sold. So, Mark, it's a kind of an interesting question because I don't know if you sold the practice from outside the entity you were in and so forth. But I've worked with dentists on this before, that they actually, once, in fact, one time we did a situation where the practice was going to be sold at the end of the year. They're also selling their building that they own. So they sold the practice in December, sold the building in January, which let them use a 1031 exchange to avoid capital gain on the building. I mean, this is why I love tax planning, because it's such an interesting puzzle and unique to every single person. So I really, really, I enjoy it a lot, because it's like, trying to figure out how to save people money. You know what I mean? Which everybody loves saving money. Everybody loves paying less tax than the maximum, which is great stuff. And the results of poll number two, 72% have said, the question was, do you feel like you have a good understanding of the value of tax planning? 72% said yes. And we have 12% not sure and 60% no. But I think we've achieved some pretty good education if we have 72% or yes. Um, what state is my CPA practice located? We're actually in multiple states. We're one of the top 400 firms in the United States. We have 85 people that work for us. We have offices in Massachusetts, uh, Texas, Oklahoma, California, but we support people throughout the country. Okay, because so much of the work that we do is QuickBooks Online now. It's all cloud-based, QuickBooks Online, and everything else like that. So we can practice in every single state in the US, and sometimes we also work with companies that are in the US but are based overseas. Name of the receipt software organizer, once again, please. That's from Todd. Todd, the receipt organizer, you could use Receipt Bank, you could use HubDoc, and there's a few others. Those are the two that I'm most familiar with that people use. Okay. Or you could also Google or ChatGPT. What's a great receipt software organizer? Cloud-based, really. And all those are cloud-based, and they're really amazing. Like HubDoc we use quite a bit. So all you do is take a picture of your receipt. You can take a picture with your phone. It goes up into the cloud-based system. It reads the receipt and organizes it by vendor and by month, right? So it's like this entire database of of all your receipts that are saved in there, and it's what I call a virtual automatic file cabinet. So you can look at it anytime, right? And you can download the information anytime. And like to go back to the question, it stays there forever and can't be lost, right? So I've had people in the past that just scan things into their computer, receipts and other documents, and their computer breaks, their hard drive breaks, or it gets stolen and they lose it. So to conclude, tax planning isn't just about saving money today. It's about us building a secure and prosperous future and proactively saving that money for the future. And I mean, you can just, if you can save 40% of your tax burden every year, I mean, I mean, the future, your family's going to be happier, you're going to be happier, your practice is going to be more successful. You'll be able to take control of your finances and watch your goals become more achievable. Very, very important. I don't have a physical, Todd's asking, do I have a physical office in Florida? I have clients in Florida. Okay. You know, it's not going to be a problem for us to work with anybody in Florida. Todd asked that question. Todd asked a question about audits and everything else like that. The IRS has a very interesting audit process, and it's under an incredible state of flux right now because of IRS staffing. If you don't mind me talking about this for a couple of minutes, people are always fascinated by this, really. 2 or 3 days ago, the IRS announced they're backing up for audits because they don't have the people. They took heavy hits under the first Trump administration. They took heavy hits under the situation with COVID. They lost a lot of people and they can't replace people. So they're having a difficult time. And now Biden was trying to replace and hire a bunch of new people. And now Trump's like making them get fired again. So the audit process, auditor comes into your office. You can always disagree with that auditor in your office. We can also handle things completely remotely. Many auditors are working completely remotely. The days of that auditor coming to your office are not the same as they used to be. Okay. And all the appeals officer, if you have a disagreement with the auditor, you go to appeals, all the appeals are handled remotely. Okay. We rarely, even though the IRS is not auditing as much as they used to, and they're now saying they're going to back up from auditing because they don't have the staff. You are surprised at how. I'll give you a good example that happened this week. I have a client that came to us and asked us to help them with their audit, right? It's not a, we're just doing audit representation for them. We didn't do anything else. But the client and I was on with an audit supervisor and the auditor on a team view meeting. We met virtually, okay? So those days of having to meet face to face are no longer there, okay? So we met virtually, and my client is like, I have to be out of the country. And then the IRS supervisor was like, that's fine. We'll do a team meeting. You can join from anywhere. I think they were actually heading to the Middle East, and they're like, okay, we can do it from there. Okay, not a problem. So it is very, very, very much more a virtual world than ever before. Ranu Mishra asks, if our company pays us for home office or meetings at our home, how is it saving taxes because we're paying? No, you will not. This is what the loophole is. The Augusta rule in home office reimbursements, it's a deduction to the business, but it's not income to you. The home office situation is a working fringe, okay, which means it becomes a fringe benefit and it's not taxable. The Augusta rule is the same way. It's a deduction to the business, but it's not income to you under the Augusta rule loophole. So you're basically taking taxable income and making it tax-free income, and you don't have to pay on the personal side. Boy, Tyler, what is a defined benefit plan? We would need to talk about that because it's essentially what a defined benefit plan is. It lets you specify the benefit that you want to take and want to be paid in retirement. Okay. And then that benefit it gets calculated so you can put more annual contributions in. Okay. Salaries. Oh, and Michael Sprague asked, you commented on salaries for college-age children. Any ideas, options? Yeah. Actually, what I did when my kids went to school, I paid them about $30,000, $40,000 a year to work in my business. And they went in and I gave them that money as a salary so they could pay for their own college. And then they applied for FAFSA using only their own individual salaries. Okay. They didn't use me as a person, as really part of their parents. It's really where they're independent. Okay. And so my kids were able to get additional better cost loans. They also got more, scholarships and different things like that. Paul Lowenstein, HSA. If I pay my medical costs without using my HSA account monies, can I, in retirement, use my HSA reimbursement? Exactly. Can I use my HSA reimbursement on previously paid medical costs? Previously paid medical costs. Well, we can save that for retirement, okay? Um, and use that on your retirement medical costs, right? But what if you're saying we can use my HSA for reimbursement of previously paid medical costs, you can't double. If you're saying, can I double dip? No, you can't. Okay. If you're writing it off as a medical cost on your business, you can't write it off again in the HSA. How many hours do anonymous? How many hours do kids or spouse have to work to earn salaries you're mentioning? Um, you want to look at $15,000 a year, right? Is about 12, it's about 1,100 bucks a month. You want to pay them an amount equivalent to some of your other staff and then figure out the hours from there. Okay. Um, and then Todd says, I'm glad to hear you thought about home office deductions. My accountant wouldn't let me take those deductions, let alone use the Augusta rule. Well, Todd, that's the problem that we have. Um, ugh, boy, that is the problem. That is the problem that we have with too many people. Your accountant is a box filler. Okay. I'm just going to be blunt with you. They're taking numbers, putting them in boxes and not thinking about other things. These are legitimate loopholes that you can use, and they should at every single. I kind of have a love-hate relationship with my profession in a way, because I hate the fact that they're not doing everything they possibly can to save you money on taxes. But I love that they don't, because they're easy to compete with. That's all I can say. But they definitely should. Any advice for dentists being drugged through a divorce? Yeah. You need to um, watch your business valuation. Okay. And that is probably a 40-minute discussion that we don't have time for right now. But you can definitely reach out to me and we can do a consultation. But we got to watch the valuation of the practice and seeing what we need to do to make sure we can minimize your uh, uh, costs related to that situation. Because the key is, when you get your financial people in a divorce situation, the family courts are very, very weird. The laws are weird. And you need to make sure your numbers are properly analyzed to make sure that the valuations are correct. Man, Rano asked for individual FAFSA form for kids, how much minimum they need to be paid. I would say around $30,000 a year, but it's going to depend on what the college that you're sending them to is going to cost. I was in one of my kids was in the UC system, and I would think they were being paid at the time. This is a few years ago. She since went on to pharmacy school and graduated pharmacy school, so it was maybe 6, 7 years ago. I think it was around 27 or 28,000 I was paying. And really, it's kind of a good way to do it in my view. I thought it was anyway, because they get this money, and I'm like, don't come back to that. I gave them the money. I said, this is what you're going to use to pay for your school. And you're in kind of a controlled environment. You have your meal plan. You know what your rents are going to be. They're usually a little bit lower. And it's a kind of way for them to try to run their own budgets. You know what I mean? In a sort of controlled environment. And I told my kids, don't come back to dad for more money. This is the money that you have to pay for school and pay for your life. Now you figure out how to work it. Right. And it worked, actually. I'm not going to guarantee that one works, because it's all going to depend on the kids. Right. So. Yeah, we'd have to work that. Okay. We'd have to work that, Ranu. Okay. So she's got a follow-up cost. Last year cost was 21K. She had individual tax return, but FAFSA. How much did you pay her? I guess would be my question. We could do a consultation and take a look at that as well. Okay. Because also FAFSA should not include, yeah, you probably wanted to go a little bit higher. You said 18K. I would go to 30. And quite honestly, FAFSAs also are not, you should not be including the profits generated from your business. Okay. And that could be a way that you can structure that as well. Okay. Oh, Todd basically came up and was talking about the same thing I said. Sometimes it works and sometimes it doesn't. Right. So with the kids being reimbursed for school.